My name is Rob Murphy. I'm head of the investment companies team at Edison. Just like to welcome everyone to this webinar, which is Finding Value in the UK. So a very topical issue. I'm delighted to be joined by some great speakers today representing the UK investment universe. We have Simon Gurgle from Allianz GI. He's representing Merchants Trust. Laura Froll from Janus Henderson, representing Lowland Trust. James de Upper from Majedi, the Edinburgh Investment Trust, which you may recall has recently been taken over from another manager. And finally, Alex Wright from Fidelity International, who is running the Fidelity Special Values Investment Trust. So just like to welcome everyone. Thank you for coming along. We also have two speakers from Edison, Alistair George, who is our strategist, and Joanne Collins, who is one of our investment trust analysts. So we'll be doing a little short presentation from them as well. So maybe to kick off, I thought we'd have a little poll just to get things started to see how people are feeling about the UK. So my colleague John, can you put the poll up and then people can just vote? So how positive are you on the relative outlook for the UK market? So effectively, relative to other developed markets, very positive, positive, neutral, somewhat negative, or very negative. So if people could click their choice, and then we'll see what happens. So I'll give people a minute just to quickly do that. People may have noticed today in the FT there was an article on the UK and the I think it had the sectoral PEs in there. Yep, so that's a fairly resounding positive or very positive. So so we've got an interested crowd on the line. So that's great for everybody. Thanks, John. So I won't waste any more time. I'm going to pass on to Alistair George, who's going to put the UK market into a bit of a global context. Okay. Please go ahead, Alistair.
Thank you, Rob. Jan, could we get the slides up, please? Great, thank you. Okay, so my name is Alistair George, and I am Edison's investment strategist. I want to talk about what value investing means for UK investors, what some of the challenges have been in recent years, and why, despite these challenges, the value investment discipline should remain at the core of investors' processes. It's definitely an interesting time to be talking about value investing, particularly in the UK, after such a dramatic recent underperformance of value indices. First, I think we have to be clear about what we mean by value investing. We're not talking about a mechanical bias towards higher yielding securities, which leaves faster growing companies to other investors. Actual value investing is a discipline focused on the long-term expected return to equity investors. Prospective growth is a part of value investing, but only represents one piece of the overall investment decision because it is uncertain. Balance sheet strength and the durability of the business model will rank relatively highly in the value investor's mind as they reduce risk and underwrite the expected return. So on the first slide, we can ask the question, does this discipline and due diligence actually work in practice? Historically, a bias to owning securities at lower valuation multiples has resulted in stronger returns. The longest data series for this is the US, and we can see that investing in the S&P since the 1880s has been significantly more profitable in the long term over the following 10 years if shares are bought at the lowest valuation decile on a cyclically adjusted PE basis. And the relationship is fairly linear. As you buy more expensive securities, the 10-year holding period return tends to drop on average, and significantly so, actually, looking at that chart. So at the moment, the S&P 500 is at 34 times, about as high as at any time outside the original dot-com boom. So the challenge for the value investing style is largely down to the recent outperformance of growth versus value indices. Next slide, please. This is also a key factor behind the relative underperformance of UK markets since 2017. We've had Brexit uncertainty, but also a value-heavy sector weighting. From my perspective, the global underperformance of value has cast a further shadow onto the UK market relative to other developed market peers. The outperformance of growth has been driven by two factors, one of which is one-off, and another which is likely to mean revert in favor of value over time. We have to accept the very recent outperformance of growth has some support from a relatively better earnings performance of digital and technology sectors during COVID, something which cannot be overlooked, but is also a one-off. But it has also been driven by a rapid expansion in forward valuations of growth stocks. Moving on to the third slide, please. We can see in the cyclically adjusted PE for the whole market is at 34 times, but by splitting the market into growth quartiles and looking at the premium to the long run average price to book multiple for each quartile, the picture is even clearer on a global basis. At the moment, the fastest growing global stocks are close to twice their average 10-year price to book multiple. In this unusual environment, we think that investors are better off focused on companies which have both a future and also meet traditional investment criteria for valuation and shareholder returns. In our view, the recent underperformance carries lessons for those wedded to an overly rigid value style. Perhaps the future brings promise for the agile and forward-thinking value investor, particularly in the UK, where corporate governance is good and there is a quite proper focus on shareholder value. So if we can expect vaccines to bring the developed world into a post-COVID mode by the second half of 2021, slide 5, please. As economies recover, real interest rates are likely to rise from their record low levels. This should favor value over growth and value-driven markets such as the UK. There's also been something of a savings boom amongst consumers in the UK and elsewhere. Moving on to slide 6, please. With the current government unlikely to swing back to a massive austerity until the recovery is well underway, some of these savings are likely to find their way back into consumer spending. So while the growth of the digital economy is unlikely to be fully reversed, in the short term, the consumer may switch back to the physical economy, catching up on discretionary spending, which involves actual human interaction, whether eating out, entertainment, or holiday travel. A pause in the digital trend and some challenging comparables could yet mean relative earnings momentum could even favor value over growth by the end of 2021. Most importantly, from a strategy perspective, valuations have in the past reverted back to their mean, either through a long period of weak returns or a period of disappointing earnings. We can remember that stocks such as Microsoft, Dell, or Apple were the market laggards in the previous cycle to banks and real estate, despite emerging as dot-com winners a decade later. So for now, the draw of growth stocks may be strong, but the sheer premium to historical multiples suggests that value investing now deserves its full allocation at the core of investment portfolios, and a post-Brexit UK is a good place to start hunting. With that, I'll go back to Rob. Thank you.
Thanks very much, Alistair. And I meant to say at the beginning, we'll have a Q&A session after the panel discussion, which follows shortly. So we'll now hand over to Joanne, one of our investment trusts analysts at Edison, Joanne Collins. She's going to talk about the principles of value investing and put it into a little bit of context as well. Thank you. Go ahead, Joanne.
Thanks, Rob, and good afternoon, everyone. Value investing goes back a long way. The father was Benjamin Graham, and his book, The Intelligent Investor, was published in 1949, and it's still in print. The principles that he enunciated in this book were adopted and popularized perhaps by Warren Buffett more than anyone, and by his partner, Charlie Munger. But there have been many proponents of value investing since. And our gathering today shows that the debate on the merits of value investing still continues. Let's take a look at some of the principles underlying value investing. They include to seek solid investment returns by investing in high quality companies at reasonable prices, to analyze companies' balance sheets and earnings growth to ensure their quality and sustainability, to make a sober assessment of value and build a margin of safety into valuations to minimize the risk of being wrong, to monitor holdings to ensure their business proposition remains sound, to watch out for disruptive innovation, which undermines the investment case, and finally, to be patient, to identify good businesses and be prepared to hold them, probably through several market cycles. So all of this sounds very reasonable and a sound way to approach equity investments. But as Alistair's already said, value investors have seen their performance lag growth strategies significantly for some time. Slide number 2, please. This shows the UK market, but I think the story is the same around the world. The current disparity between value and growth strategies really began in 2008 after the global financial crisis started, and it's continued to deepen, and the gap between the two lines on the chart has continued to widen ever since, and it's been worsened by the pandemic, to the point where the current cycle of underperformance of value versus growth in the UK market and around the world is now the longest in history. The reasons for this, Alistair's already covered, so I won't dwell on them further. But I think one point to make is that despite this widening gap between growth and value, value investors' convictions in their approach has not wavered. And I think as an illustration of this, last year in the UK investment trust sector, we saw several trusts, for one reason or another, being in the position where they needed to change managers, and they did surveys and ran tenders to find new managers. And in each of those cases, when given the choice, the shareholders in these investment trusts opted to adopt managers who followed a value-focused approach. They didn't choose to step away and go to perhaps growth strategies, something that arguably might have been more appealing. They stayed with value. We can't say when value will reassert itself, but history and probabilities suggest that a rotation back to value is inevitable. And the current extremes of the disparity between growth and value strategies suggest that the rotation may come sometime soon. In fact, there are signs that value is already beginning to return to favour amongst investors. If I could have the last slide, please. I'll go on anyway. Maybe the slide will come up in a moment. Really, thank you. It's the same chart that we looked at before, but over a shorter time frame between September last year and the current time, the beginning of February. And what that shows is that in November and December last year, value stocks in the UK, along with their counterparts around the world, started to catch up with growth stocks. This was prompted, as Alistair said, by the arrival of several viable vaccines and the associated improvement in the economic outlook, which equity investors were quick to realise and to express their optimism by a move back into value stocks, as they started to recognise the value in many of the companies that had been left behind at the beginning of the pandemic. What this last slide also shows is that the rotation into value seems to have stalled this year so far, but value still has a long way to go to catch up with growth strategies. So perhaps we are just at the very beginning of a sustained and significant and arguably well overdue rotation back into value. So I'll hand back to Rob to lead the discussion on what our expert panel sees ahead for value investors. Thank you very much.
Thanks, Joanne. So let's kick off with the questions. So let's start off, as Alistair and Joanne just explained, the UK market does appear quite discounted. So do you agree the UK is cheap? Is it cheap in absolute terms or just relative terms? And what do you think investors are missing currently in their assessment of the UK? So let's start off with Simon. You know, you're sort of managing large caps, a lot of international companies. Maybe you could have a stab at that one.
Yeah, thanks. It's a good question. I do think the UK is cheap in absolute and relative terms, but actually more important than that, it's polarized. So certainly not all companies in the UK are cheap. Quite a few look pretty fully valued to us, but there's a very large section, something like 20–25% of the market is on a single-digit price-earnings ratio in 2022. So we see large parts of the market where there is significant value, other parts where it's not that cheap, and therefore we wouldn't necessarily say you should buy all UK stock. But so I'm getting good feedback. But I would say that there are certainly parts of the market that are really interesting. Perhaps there's a sectorial bias for why the UK is cheaper than some other markets, which I'm sure we'll discuss. But I think even if you adjust for that, the UK still looks good value.
Right, thanks. Maybe James, because I think you have a mandate to have quite a lot of potential foreign stocks in the portfolio, but it's not very high at the moment. So does that say something about what you feel about the UK?
Yeah, it does. I mean, I think, you know, I took over the Edinburgh Investors Trust in March, and why I say that was, if you look back to March, it's easy to forget how negative people were both on the UK and everything. But, you know, the UK had a headline running, you know, sterling gets hammered as London goes into lockdown. And why I say that is, you know, we've actually got a massive change now in the UK, because actually having not had a great crisis up until now, as in sort of the COVID crisis, what we've now got is we've got a massive amount of vaccines, you know, 2 per capita. It looks as if we're going to exit faster than most countries because of our vaccination rate. You've got sterling recovering, so it's moved from 115 to 138 or so at the moment. And you've got a huge amount of companies being bought, either by private equity or other corporations. So, you know, you're right, Robert. I haven't used the full overseas allocation for the Edinburgh Investment Trust at the moment, because, you know, if I just see there's a lot of value in the UK at the moment, and I don't want to miss out on that. I mean, I think it's really difficult to underestimate. Let's say we were having this webinar in Tokyo or you know, New York, and you did that poll. You know, people wouldn't have a great view of the UK, I think, and there's a lot to catch up on that, and I think we're in the early innings of that.
Great, thanks for that. Maybe Laura, because you also look at a lot of smaller companies, so maybe there's something you can add on the kind of companies you're looking at.
Yeah, I would agree with Simon and James that there is this value opportunity in the UK, and I think we're feeling quite vindicated in the last few months, both pre and post Brexit, about the amount of corporate activity that's happening. And that's happening in small cap, but actually it's happening across the market cap scale. So we had RSA, which is obviously a large company, be taken over towards the end of last year. And then very recently, we've had bids for some of our smaller companies. You know, we had one a few days ago for a company called Arrow Global. So there's really this corporate activity happening across the market cap scales and not just in small cap. And that's leading us to think, well, to give us some vindication, thinking, yes, that, you know, there is actually value here. And that those bids are coming from a combination of private equity, from international peers, so really a range of different bidders. And I think that positive about the UK, that we do have this open market for corporate activity, had until very recently been forgotten. And it was something we thought would be a theme for 2020. Clearly then COVID came along and it didn't happen, but it is now happening again quite recently. So that's something we find really quite encouraging.
Great. Finally, Alex, you know, how do you how do you see the you know, the UK market, you know, in relative or absolute terms?
Yeah, so I think I'd agree with the other panelists that there's a strong absolute value opportunity here, not just a relative one, and so it is a particularly unusual time, in that it's the time that in my investment career over the last 20 years I've never seen so much opportunity and risk at the same time in the stock market, and very much I'd put the UK market in the opportunity part of that, in that it really is at a low valuation versus its own history, not just versus other expensive markets, and particularly the US market, which is notably expensive. And I think the UK has several advantages compared to other markets, not just that it sort of went into this crisis already sort of unloved and undervalued, but actually the short-term effects of the crisis have been bigger. And so actually the bounce back can be both sooner because of where we are on the vaccine trail, and actually because the UK consumer has saved up so much money through this period. I think there's every potential that the UK consumer has a very strong period. So it's not just about valuations being low. Actually, I think the UK fundamentals from here, because of the pent-up demand and the nature of the UK economy, actually puts us in a very good fundamental position going forward as well.
Oh, great, that's interesting. And you brought up the issue of risk. So maybe I'll go around in turn now and just ask you. We're calling this a sort of finding value in the UK, and what does value mean to you, and how do you employ that in your process? I think we might describe it as valuation disciplined. I mean, maybe start with Simon, because your mandate is also to generate income for your shareholders in the trust. So yeah, please go ahead.
Yes, well, at the Merchants Trust, we do fish in the income pool. So we fish in the pond of companies that can yield in line with the market or above on 18-month view, but that never determines the reason for buying a company. We're always looking for companies where we think we can make a good total return. And for us, value is partly what was explained earlier about the fundamental drivers of a business, its competitive position, all the risk factors compared to the price, and so assessing the intrinsic value compared to the price. But I think the other thing that's really critical is what's going to change. What are the thematic drivers out there, which can be really, really powerful over many years. And often the value traps come from companies that look really cheap on a historic basis. But when you think about what's changing in that industry, it might be demographics or digital trends, you can get wrong-footed. So for us, value is about companies that are good businesses and cheap, but also have supportive trends, or at least don't have negative trends or themes which can overrule that. And if you get that combination right, it can work very well. And just one other thing, it's people often think as value and growth as opposites in different sectors, but companies move from one part to the other. Companies change over time. We've got companies in our portfolio, a small one called Kin + Carter, which used to be called St. Ives. It used to be a printing company. It's now a digital transformation company. It's completely different to the business it used to be. And yet, it would have been a value company, and now it's probably a growth company. So companies don't stand still either. And therefore, it's not just about identifying companies that are valued today, but companies that can become better businesses or higher growth businesses in the future.
That's a good point, actually, Simon, because I think I know when I've studied the value effect, actually a lot of it is companies moving from sort of one quartile down to another one and then back up. So, a growth company disappoints and the growth investors sell it all, and then it becomes a value stock, and then the value investors pick it up, and it's that move. It's that part of the effect is the move across the different quintiles of valuation, which speaks to, I think, most value managers are actually quite active, so they're not. It's not a passive approach to delivering performance. It's picking things up when they become very attractive and then rotating into new ones once they've worked. So I mean, maybe James, you could talk a little about what it means to you. I guess your approach is a little bit more eclectic than some. If looking at your portfolio and Majedi, as a whole.
Yeah, we're very much flexible investors. We do have a total return approach. So in the Edinburgh Investment Trust, I have both a capital and income requirements. With my colleagues at Majetti, what I'm looking to do is put together a 50 stock portfolio, very much ESG integrated throughout. And, you know, this last year has been fascinating in a way, because actually, you know, a lot of the trends have accelerated enormously. So actually, that fundamental approach has required often quite a lot of imagination, because, you know, you can name all sorts of industries where the competitive landscape has changed much more than you'd expect. I mean, this morning I was listening, for example, to the Dunelm results call, one of the holdings we have in the Edinburgh Investment Trust. And if you think about the competitive dynamics there, you know, they've seen Debenham slip away, all sorts of independents now slip away. And actually that business has emerged much, much more strongly and will emerge much, much more strongly. So sometimes when you're doing that fundamental approach and the analysis, I think what you'd also need is that sort of dose of imagination to think, gosh, how's the competitive situation going to look like in 3-5 years' time? Because actually, you know, sometimes people think a bit too short term, I'd say.
Absolutely. So you raised a couple of points there, James. I guess one is the sort of disruption. So maybe I'll go on to Alex. I mean, because you talked about risk, and I guess you're thinking about that as one of the risk factors, as well as, I guess, the macro side. So I guess that's the value trap is always the sort of worry people have when they're thinking about this you know, a more valuation disciplined style. So maybe you could describe how you avoid getting into those sort of issues.
Yeah, so it's a really important thing that we do in special values. It's a lot of due diligence on the individual investments using the very wide analyst team that we've got at Fidelity, and that's been particularly useful actually in the pandemic, where you're not able to get out and see the businesses. The fact that we can talk to people that are based in Hong Kong, in Sydney, in Toronto, in mainland Europe, to see what's going on the ground, because actually, clearly, when you're looking at turnaround, so value cases where companies are cheap, that the management teams are going to present well to investors, and indeed talk to lots of investors. But actually, we want to back that up by seeing what's happening in the marketplace, and we want the current returns, which are generally low for value stocks today. We want ones where we've got confidence they're going to be higher in future, rather than just stay low or potentially deteriorate. And so actually an area that we've added to a lot this year is actually in the consumer space, where we think actually the big companies have got stronger through the pandemic. So larger house builders have done much better through restrictions, because they clearly have multiple sites. It's easier to set up new procedures. Similarly, in retail, actually an area that people think is severely disrupted by the internet, actually, if you are the number one bricks and mortar multi-channel retailer, you've done particularly well. So we've got a number of those in the portfolio, like Halfords, Kingfisher, Dixons, that have actually responded extremely well through COVID, because they had very substantial online offers and were able to switch the business. So I think that's a really important thing, making sure that you've got strength within an industry and seeing where your competitive position is a really key part of value investing, because you don't just want to buy cheap companies and hope that things get better, because in many industries they won't, because they've been disrupted. And certainly I'd think one area where I think that is the case today is actually in the oil space. I don't think we're going to see the returns that you used to see in that area. So sort of people say that's a very value part of the UK market, and indeed they are very cheap stocks, but actually we have very low weighting in that area and don't own any of the UK large cap oils, because actually I think returns are going to continue to fade in that area of the market.
Yeah, that's an interesting point, and I guess I just like to just to bring Laura in on how they sort of look at the disruption area, but I'd like to come back to the oil side and also ESG. I think that James brought up, so we've got a few things to follow up. So Laura, so how do you avoid, how are you looking at value traps? And I guess another way to think about it is, have you had to change your process given the kind of dramatic technological advances we're seeing? Do you have to look at companies in a different way now than say 5-10 years ago?
Yeah, I think what we've learned, and certainly what happened during COVID, is that structural change that was already happening happened much, much faster. You've seen it with physical retailing, that change that happened last year was probably 5 years worth of decline in 1 year. And I think behavior has probably changed permanently. We own Tesco within Lowland, and their share of online retailing has grown hugely. And I think a lot of those people that have experienced for the first time ordering food online probably won't go back to shopping in the supermarket. I think we have to recognize that a lot of that change has been structural. So I think what that means in terms of our process is that we need to be extremely careful of buying companies that have got a declining top line, because those analyst forecasts that show a fairly modest top line decline may well not be right, and that decline might be much, much faster than you're anticipating. And what that means for us is, for example, in Lowland, we have no tobacco exposure at all. I find companies where there is volume decline every year very difficult to model, and I find it very difficult to put a valuation on that. And I think, the advantage that I think we have in investing across the market, going right down to AIM, is that there are no sectors that we have to hold and no stocks that we have to hold. So if we come across a company where, actually we think that's very difficult to model, it's in structural decline, we don't have to hold it. We don't have to be near the index in any way. And that, I find that much easier being an income investor that can go all the way down to small cap in that respect than maybe one more focused on the large cap elements of the UK market.
Those are good points. So Simon, Laura brought up the COVID, as changing things. How do you think COVID is going to change shorter term and long term thinking about the UK economy and the prospects for that, as well as, the sectors and companies? It's a very wide ranging sort of open question, but what are your sort of key thoughts there?
Well, I think it's a lot of it's unknown. So, for example, if you take working from home, working from the office, most of us are working at home at the moment. I think many of us are quite keen to get back to the office, but there's a big debate. For example, if you look at office property companies, to what extent will people go back to the office? How much space will they need? Companies need, and when people come back, will they actually need more space? It's too early to actually know the answer, I think, on that question. But there are other areas where I think trends will change. For example, the use of these type of seminars rather than physically going to trade shows and exhibitions around the world. I think trade shows and exhibitions is an industry we used to have an investment in. We don't anymore. I think we're a bit nervous that that will change. But in other areas like physical retail, I think people want to go back to shopping. Actually, a lot of people, not everyone, of course. And I think Laura's right. We have probably had a 5-year acceleration in the amount of online trading, but that doesn't mean that there's no future whatsoever for shops or restaurants or cafes. I think some of that will come back. So I think it's a good question. I think it was Alex who said that consumers have got a lot of money in their pockets. Some of them, clearly unemployment has picked up and may continue to pick up. But for people who've still got a job, and often they've been saving a lot of money in the last year, there's pent-up demand, arguably, for spending. So one of the areas we've got significant investments in, which I think Alex touched on as well, is the whole house building and home improvements area. Either the house builders themselves, which are trading extremely strongly, surprisingly, perhaps, but also companies associated with that supplying parts and components for buildings, supplying furniture. Many of those businesses, we think, have a good outlook, certainly for a few years, not just for 6 months, and valuations there are pretty modest. So I wouldn't draw too many conclusions about what's going to happen on the long term, because we don't really know all of it. But I think there are businesses that will come out in a better shape for the next few years at least.
Great, thanks, Simon. And I think the other point that came up just a bit earlier was ESG. Is ESG investing compatible with a sort of valuation disciplined approach? Alex, would you like to start maybe on that one and give me your thoughts?
Yeah, so I think it very much is, and I think ESG actually increasingly goes to the heart of everything within investment, because it's not just a sort of separate discipline. It's looking at sort of how companies are aligned with sort of governmental, sort of environmental and social goals going forward, which is much more important, I think, than it's been historically, because there is quite a big sort of agenda coming from the wider society and governments in terms of sort of how things need to sort of look going forward on the environmental and social front. And then governance has clearly always been extremely important for shareholder returns. Having appropriate governance and aligned shareholders' interests with management interests is something that's key. And I think you can, the important thing I think within this though is to realize that it's much better to engage rather than to exclude. So I think certainly at Fidelity and within my mandates, there's basically no stocks that we can't invest in. It's all about making sure that there's a positive change within those companies. And if there are risks, so there are sectors, to, for example, where the E and the S are always going to look bad, for example, sort of defense, that by its very nature looks very bad on ESG, that we take that into account in the investment and see how that affects the valuation we're willing to pay. So we will buy things that have question marks in ESG, as long as there's improvements that we see being made. And very much our internal rating system at Fidelity is very much forward-looking on that basis. So it's integrated with the analysts that do the fundamental work, so that it's not a separate team. It's very much an integrated team that consider the business together with the ESG risks to get, I think, a much more fundamental view of actually how the ESG affects it, rather than excluding companies just because of the sectors they sit in, or indeed things that may have happened historically. So, for example, a lot of stocks are excluded from ESG specific mandates in the financial sector because of things that happened a decade ago, which actually I don't think is now particularly relevant to the go forward. So I think it's an area that's really important, but it is an area that you need to really understand and not take a sort of a formulaic or a sort of a ticks box view, which unfortunately I think actually a lot of the external rating agencies are still doing.
Yeah, those are good points, because yeah, obviously if you buy a wind farm, that all ticks a lot of the boxes, but if it's an ugly industrial and it's improving things a lot, that might be having a more beneficial effect on the overall sort of so ESG sphere. Maybe James, I mean, you mentioned ESG earlier, and that's something that you incorporate a lot. You could say how that fits into the I guess it's the risk versus the is ESG really mainly about risk, or is it also about return? And that's one thing I sort of juggle around in my own head. So maybe you can add something on that.
Yeah, well, I think if you're going to hold, as we do, ideally hold a share for 4, 5, 6, 7 years, you've got to be really sure that those profits and prospects are scoped in a way that works for all stakeholders. It can be employees, it can be the environment, it's got to work for the ecosystem. And so whether you're a value investor or a growth investor, it has to make sense to think about that. If you think about all the issues in the world, there's a massive leveling up inequality issue. So actually capitalism to work has to be responsible. And as soon as you overstep the mark and get into, what used to be the sort of syphilic green type capitalism, you kind of got a problem, haven't you? Because it's not going to work. And so, the likes of Tesco really have that. They know what they're doing. And, sometimes industries which have had a bit of support from the state. So take the house builders we were talking about. They've also got a legacy issue in cladding. It's changed a lot, but they have to actually play their part in solving that issue. So we're all part of one system. And I think, you know, nowadays with investment, you really have to think about all these bits of the jigsaw, because it's not only about risk, it's about opportunity, it's also about resilience. Because one of the big things, you know, we're talking about how economies are going to exit, you know, and, you know, a number of people, which I agree with, thinking about quite a lot of pent-up demand. Now, if we're going to satisfy those bits of pent-up demand in what actually is quite, in areas, quite an underinvested system, so think, well, think freight, for example, or think other elements of infrastructure, you need quite a well-developed supply chain so you can get your product to the consumer. Because, you know, how many products have we all tried to order recently and it's out of stock? You know, resilience comes through all sorts of elements of the P&L. And so that's why I think ESG really is so important. And it's not something which can happen just like that. The good companies in ESG terms have really been working incrementally over time. You know, they've long ago forgotten about the Milton Friedman idea of capitalism, which is, you know, your main responsibility is to make profits. They've thought, you know, really carefully about how they calibrate profits relative to other stakeholders.
Right, that's a good answer. So I'm just conscious of time, so maybe we'll just zoom around the panel. Obviously, you're all portfolio managers and you run a portfolio of different ideas, but it would be great to know, maybe starting with Laura, you know, what do you see as the most exciting, either a stock or sector, you know, over the next 12 months? What are you most excited about in your portfolio? Start with Laura.
We're still quite positive on the industrial sector, and that's one of the biggest overweight positions within Lowland. I think what people are missing on industrials is the amount of cost saving that's happening. So not only do we think there'll be a top line recovery starting in the second half of this year and going into next year, but I think what most analysts are doing on industrials is taking 2019 earnings as a base. And I understand why. I think I'd probably do the same if I was a sell-side industrials analyst, but they're just taking the 2019 number and sticking it in for 2022. And I think what that's missing is that a lot of the companies that we hold, you know, names like Morgan Advanced Materials, TT Electronics, they're closing facilities, and those facilities are not going to reopen. So in both cases, they're saying that we're saving whatever it is, 10, 20 million of costs, and our margin is going to be structurally higher when we come out of this than it was going in. And that's not currently baked in, well, as far as I can see it, that's not baked into analyst forecasts. So I think what we could see is quite a powerful combination of earnings upgrades on an already quite low valuation for some of these companies. And that's quite a powerful compounding effect when it happens. And that's exactly what happened coming out of the financial crisis as well, that actually that operating leverage, when sales begin to recover, can surprise people to the upside. So that's one area that we're quite positive on. And I would also agree with the likes of Alex that this savings ratio in the UK, in my experience, when UK consumers have savings, they tend to spend them pretty quickly. I can't remember the savings ratio ever staying up for a particularly long time in the UK, at least not in my memory anyway. So that's another area that we're positive on and looking at actively at the moment. Brilliant,
thanks, Laura. I would agree with that. With the amount of boxes that keep getting delivered to our house, the shopping hasn't stopped. Simon, maybe you could you know, what are you really excited about now?
Well, I touched on the house building and associated area earlier, which I'm really excited about, but I'd like to circle back. If I talk about the energy sector, because that's a bit contrarian at the moment.
Sure, yeah.
Bring it back to ESG as well. I mean, we absolutely think about ESG issues very closely and engage with businesses. But if you want a solution to the energy crisis and the energy transformation, the big energy companies have to be part of the solution. They have the balance sheets, they have the cash flow, they have the assets, they have the people and the project management skills to do this, and they are actively doing it. And there's been a massive change in the whole operational environment for the energy companies. We've seen BP announce really radical changes. We've got the Shell Capital Markets Day tomorrow. So I think they will be part of the solution to this, and they need to be part of the solution. And just to give you one example of how that's worked in the past, a few years ago, I can remember investors not wanting to invest in SSE, Scottish and Southern Energy, because it was a big coal generator, if you remember that. It's now the UK's biggest renewable generator of power. And the attitude has changed 180 degrees. So sometimes there's scope for businesses that are potentially very, very cheap on a long-term basis to start on a transformation, which can be quite significant over a long period of time and can surprise you with how well they can do financially, but also they can change their whole score or their profile, which can be in a much more positive way. So I would say that's another area where at the moment we see very good value actually.
Yeah, it appears in a lot of the kind of sort of ESG and renewable funds now, that one, doesn't it? So SSE. So yeah, so
I meant the energy, but yeah.
So maybe James, just quickly, what's your top idea or?
Yeah, well, I think the top thing you need to do in your portfolio at the moment is think about inflation. Because I really think if we're going to see a pretty strong recovery with the blessing of the central bankers, that is going to lead to inflation expectations picking up from very low levels. That will, I think what Simon says in terms of commodities, I think is correct personally. Into quite tight supply, you're going to see quite strong demand. I think it's also quite relevant for the banks as well. Inflation expectations picking up. So I do think you want to think through stock selection through the lens of, thinking, well, what if inflation expectations, do begin to pick up from relatively low levels, because I just think that's going to be quite an important theme actually going forward.
No, yeah, I think so, and that's Alistair pointed to that at the beginning. Alex.
Sorry, go ahead, Rob.
Yeah, I think a key area that I've been talking about for a long time in the fund, and is the biggest overweight for me, is actually life insurance. So it's 15% of special values today, and indeed the two largest positions in the trust are Legal & General and Aviva, and we also own Phoenix and Just Group as well, so making up 15% of the trust across those four names. And I think the reason for that is it's a very complicated sector in the financials, and I think people have been very much lumping this in with banks, thinking that this is a very economically sensitive sector, something that when we get a downturn is going to be badly hit. It did very poorly through the global financial crisis, as did the banks, and therefore it stayed on very low valuations. And I thought that was very much a mistake, because actually these businesses are much less a play on the UK economy than actually a play on the global economy, because they're invested internationally through global bond markets and infrastructure. And therefore, actually, the cyclicality of the sector is quite low. And that's very much actually played out through this COVID crisis, that if you look at the UK banks, they've largely reported no profits in 2020, as they've had to take very large provisions. Whereas Legal & General and Phoenix have largely produced exactly the same profits in 2020 as they did in 2019, because of the diverse nature of their business. But these companies are still trading on very cheap valuations, even though they've outperformed. So I think this is a really exciting area where you can get high dividends, very good resiliency through crises, and also plays to the ESG agenda. So if you look at Legal & General, they're one of the biggest builders of infrastructure for redevelopment in the UK in terms of private rental, in terms of universities, in terms of working with councils on regeneration, because they've got lots of liabilities in terms of the annuities that need that long dated income. So I think it's an area that's both resilient, but actually has a lot of growth and really plays into the sort of the leveling up and the infrastructure agenda going forward, without having to pay up for it like you would do in areas like renewable energy, etc., where you do need to see a big build out, but the stocks are trading on very, very high multiples.
Yeah, great. So insurance can be exciting. So maybe we'll just go on to our poll again, John. We're going to give you the same question we gave you at the beginning, just to see if there's been any change. So let's let's see what happens, John. So again, how positive are you on the relative outlook for the UK market? So very positive, positive, neutral, somewhat negative, or very negative. So if people could please vote. And I think last time very positive was 18% and positive was about 61, I think, as I recalled. So we'll see what happens. Okay, so actually quite a big improvement. So 92% are positive versus very positive. So I think that's actually quite interesting. So people have found something interesting out of what we've said today. There is time for Q&A now. So if people can send it on the chat, or maybe raise the hand to ask a question. We've got some, I think, already. Okay, here's one from, is it Stephen Martin? Do you consider airline stocks to be of value? And if so, which one do you prefer and why? Does anyone want to take that?
Well, I think airline stocks obviously are having a very, very tough crisis, but within that, if you are well financed and can get from A to B, it is quite an opportunity. And within that, you would have the likes of Ryanair and EasyJet. And so, yes, there's a lot of uncertainty about, summer bookings, etc., etc. But, I would say in both those cases, they are not without risk, but, reasonably, interesting.
Great, okay. Here's another question. Chris Bell, structurally, there seems to be a lack of thematic, smart beta, or active ETFs that focus on value. Do you think that is having an impact on multiples? Who would like to, who fancies that one?
I can have a go.
Yeah,
I'm
Simon.
the lack of vehicles. I think it's the lack of interest in putting money there. Money has been going very definitely to growth and other quality areas in the last few years. And if you look at it's quite interesting looking more globally. Many stocks are overrepresented in ETFs. So you find that a stock like Amazon will be in the growth ETF and also the quality ETF and other ones. Whereas other companies are just left out. But I think it's about where investors are putting the money. If the money won't go there, it will find a vehicle. But because there's been such a headwind to value the last few years, as Alistair explained at the beginning, I don't think much money's been going there. But maybe that's changing with the higher inflation that James touched on, interest rates starting to pick up, and the mood of the market changing a little bit. So I'm not sure that the problem is lack of vehicles.
Okay, thanks, Simon. Here's another one. David Kerr, what, if any, distortions does leverage make to the valuation argument? I.e., for leveraged businesses, they may look cheap, but you simply own less of the cash flow and earnings. And on that basis, how does the UK look versus other global markets on that measure? I mean, maybe we could split that a bit. Maybe Laura and can start on that. You know, how you look at leverage in businesses.
Yeah, I think it really depends on the business. So, for example, we look a fair bit at the pharmaceutical sector. You know, a company in that sector can take a fair bit of leverage. You know, they often make 30% plus operating margins. It's a pretty defensive business model. So if I see a pharma company that has, you know, decent level of leverage, I don't tend to worry too much about it. Same with the utility company. I think it's quite different if you're looking at a company that either has structural decline or is quite cyclical. And that combination of operating leverage and financial leverage is where you've got to be really careful. And we're very selective if we do invest in companies that have both of those combined. When it comes to the UK versus other markets, the evidence that I've seen is that actually UK companies, particularly compared to, say, the US, have been more conservative in taking on financial leverage in recent years.
Right. Yeah, that's probably a bit sort of non-consensus in a way that people sort of imagine, but there's been this huge buyback phenomenon in the States, hasn't there, for many, many years. I mean, Alex, what are your views on leverage? And I don't know if you have an opinion on how the UK looks adjusted for that versus other markets.
Again, I think it's very tough to generalize because, as Laura said, sort of leverage is dangerous in certain businesses and is much less of a problem in others. And then also you have the unusual phenomenon when you look at other markets, and I particularly say the US. When you look at some of the big caps in the US, they actually run sort of net cash. Whereas there's some very highly leveraged businesses further down the market cap spectrum in the US. And again, within the UK market, there's a huge degree of variability even within sectors. So it's definitely something that we shy away from in totality. So we run lower leverage than the UK market overall. But I wouldn't have a strong view on how the UK market as a whole stacks up versus other markets on a leverage basis.
Okay. Alistair, do we have any sort of work on that? Maybe it's something we could look at in the future.
It's something we can look at. I'd say that the area where leverage is becoming maybe more of a concern is in the US, where corporate leverage has been rising, and obviously that you've got to be careful where you interpret the data with the split between private and public markets when you're looking at the national accounting data. But I wouldn't want to say precisely the difference between the two markets right now. What I would say, though, that every business has an optimum level of leverage, even if financial theory says that the amount of leverage shouldn't make any difference.
Okay, good point.
Robert, if I could just add, you know, I would very much, where I've looked at comparators UK versus US, you know, for example, medtech, I would also support the notion that the US tend to be more leveraged and have, you know, bigger facilities as well. But the one thing I would just add on leverage is what I also think is important in your analysis is not only to think about the company you're analyzing's leverage, but also what the competition, how they are leveraged. Because if you think about competition as a bit of a chess match, you know, it really matters how your competition is set up from a leverage perspective. And I think it really matters now because you're going to see, you know, some companies really emerge on a front-footed way, and some, you know, because of leverage, will really struggle actually to emerge anything other than, frankly, the walking wounded.
Great. So I think we've just about run out of time, but hopefully we can have one more poll. John, do you have that last poll that I was going to put up before we finish? How likely is Trump to run for president in 2024? Very likely, likely, not sure, not very likely, no chance. So maybe just get the audience's final opinion there on that one. There we go. Not very likely, 38%. So actually, there's a few percent still think very likely. So we can we can pop that into our our macroeconomic viewpoint. So thanks everyone. Again, just like to thank all the presenters who've done a great job today discussing the markets and their investment approach. Thanks all to the Edison team for getting this all together. Have a good afternoon, everybody.
Thank you. Cheers.
Bye.